Welcome to a new video that I'm trying to launch. This is called the Deep Dive, where I go through daily charts as of January 9th, 2023. In all the videos that I do a video each day, which I call the Daily Brief. And that just shows what's happening in the market and the charts that are actually telling us something. I try to highlight those in that video. Then every week I do a weekly video based on weekly charts. And then I do another video called the Intermarket Analysis, where I look at the relationship between the stock market and the bond market and the precious metals and commodities and all the different markets that are out there. Well, there's a lot of charts that I don't show in any particular video, and I want to go through those in this particular video. This will be a video that I'll probably do about once a week, and it'll just be on an as needed basis. So there might be times when I do this more than once. What I'm trying to do is limit the amount of time in preparation that I do for each daily video. The way I'm doing the daily brief right now, it takes a lot less time, where the other version of the daily videos, it would take me 6, 7, 8 hours every day just to post that day's video, which is fine. And I really enjoy doing that. But when I have other things to do, it's really hard to upload this and have it be useful, especially posted and have it posted in a timely manner. So this is, if you ever watch Gilligan's Island, this will be the rest of the charts that I don't show in the videos. There might be a little bit of overlap, but I've tried to go through this and just show you the charts that I haven't shown you recently. Now, as they become more relevant, they'll change from being on this video over to the daily brief or even the weekly or intermarket analysis video that I do. But this is as things stand as of Monday, January 9th. So first, I haven't really been showing sentiment charts lately. I've been telling you every day what's happening, but this is an actual number that's put on sentiment. And right now we're just at about neutral. And then the next chart just gives us a historical look at what has sentiment been doing. When we get to the extreme positive area, that's when we're looking for the market to reverse and go down. When we get to an extreme negative area, that means that we're looking for the market to reverse and start going back up, because that produces the critical mass that we're just not seeing right now, but we often do see when the stock market is going up or down significantly. Another chart that I look at every day just shows how is value performing, how is growth performing, and then I break it down into the large cap, mid cap, and small cap. The one that I focus on the most is the top row. And you can see this is after Friday's session, where even though we had a really strong day, value still outperformed growth. What we need for the stock market to really start going up and register some lot higher numbers is we need this growth value to outperform value on a consistent basis. But for 2022, it's just been the opposite. And I go over that also in the intermarket analysis video. Another chart that I've been talking about, but it really hasn't been doing all that much, is called the VIX. And this is a fear gauge. When this chart goes up, that means there's a lot of fear in the market. When it's coming down, that means that there's not a lot of fear. And when we drop below this blue line here, that means that we're getting a little bit complacent. And this tends to go in the opposite direction of the market. However, over the last few weeks, as the market has been going down, that's this top chart, the VIX really hasn't been going up all that much. So it's been acting kind of strange. And I've just been telling you about that in the video instead of showing you the charts. Another chart that's closely connected to that is a VIX of the VIX. It's measuring the volatility of volatility. And we can see with the bar chart, it's really been declining. And then the line chart just gives us the closing values. And that's really been declining as well. So we get our measurement of fear using other indicators, where a lot of times this one is kind of the main indicator, but it's going through a period right now where it's acting kind of strange. Another way that we look at VIX is on the bottom, I plot an RSI, which is an oscillator that gives us overbought and oversold conditions. And I plot an RSI 9 period on here. And right now we're just in about the middle. So that's why I'm not showing you this particular chart. I also like to keep track of where are we at since we hit the all-time high in early 2022. As of Friday's close, we're down 21.45% from the all-time high. Another area that I talk about, and you may have seen these in some recent videos, is the Ichimoku cloud. This is just taking moving averages and then shifting them forward. And a lot of people use these as support and resistance. Well, way over on the right-hand side, we've been right in between this red cloud and this green cloud, and we're not really dropping below that. If we significantly go up from here or go down from here, I'll probably include this in the daily video. Also, we have a trend channel, and this goes all the way back to the low set in 2009, and we're just about in the middle currently. And sometimes I bring up this chart in the videos as well. Another thing that I like to look at are sectors, because during different phases of the market going up or down, different sectors will behave differently. This is just looking at Friday and what performed the best, where it was a really strong up day. So all of the sectors, there are 11 sectors that make up the S&P. All 11 of them were up in Friday's session. Healthcare did the worst. And I look at the percent change. That's really, I don't look at the point values or anything like that. I usually look at the percentage of what went up the most and what went down the most. Well, materials and tech and real estate, as well as industrials, they did very well. And staples. We had a pretty strong up day on Friday. Then another way that I sort this same chart is I look at a thing called the Scooter scores. Said that wrong. This is using objective technical analysis tools to say, how is that chart looking? The closer it gets to 100, the better looking the chart is for continuing to go up. And for right now, the energy sector has the strongest looking chart at 98.4, followed by industrials at 94.2. When you're looking to buy low and sell high, you want to get a chart that has a really high technical analysis score. And you want to avoid the ones that are on the bottom, especially 10 or below. We have the tech sector at 10.7 and consumer discretionary, which has just been getting hammered in 2022 and now into 2023. It has a score of 5.8. So this is more of an objective way of just measuring the technical analysis score for each individual sector. This is another graphical way to show us, and this just goes back to last week from Tuesday through Friday, because we had the shortened week due to the New Year's observation day, where the best performing sector last week was energy, communication, and materials, and all the other sectors ended up being up, but healthcare was up the least. And then I go all the way back to the all-time high that was set in early January 2022. Energy has been the best performing sector. Also, utilities have been positive since that time. These other sectors, staples and healthcare, have been more flat, where all of the other sectors have been declining. So this can give us some real insight, because discretionary, communication, and tech, these are what the growth stocks are, and they've been really suffering. Then we look at how did all the other indexes do in the past week. This goes from Tuesday to Friday, where we have the mid caps doing the best, followed by the small caps. The S&P is in the middle. This is the pink one. And all of the indexes ended up being up on the week, but there might be some weeks when some are up and some are down. And this goes back to the all-time high. Which indexes have performed the best? They're all down, but the Dow has been down the least, where way over on the right-hand side, you have the NASDAQ 100 and the NASDAQ, and that's a large part of the growth stocks. And those are the ones that have really been suffering. They go up really well in a bull market, but they go down pretty fast when the market's hitting trouble or we're in a bear market. As far as technical alerts, this is just as of Friday's session. If they're green, that means they're positive. If they're red, that means they're negative. And I tend to focus more on the S&P 500, where later in the day, we were able to get back above 3,900. We also had a bullish MACD crossover. And the best way to look at this is to start at the bottom, like this bottom TSX, that's Canada. And then the Dow went above 33,000. The NASDAQ got above 10.4. Different sectors that are performing well. We had a couple of negative ones along the way, but they tend to redraw from top to bottom. So if you want to look at the most recent ones, they're at the top. The earliest signals are at the bottom. And then there's a timestamp over here on the right-hand side. Also, I like to take the major indexes and rate them according to their Scooter score. right now, as what we've been seeing since last fall, the DIA, that's the diamonds, that's the ETF based on the Dow Jones Industrial Average. And it's the best looking chart right now. And the reason I say that is it's in first place with a score of 76.2. Now, that's not very good. We want it to be into the 80s and even 90s to look stronger. But when you compare it to the other indexes, it's looking better. In second place at 73.8 are the mid caps, which are showing some improvement. In third place at 54 are the small caps. And then we have the S&P 500 at 31.3. And then in last place is the QQQs, which is the ETF attached to the NASDAQ 100, and it's at 7.7. So it's really been suffering a lot. Even with Friday's upward move, this chart is still not looking very good. Then some other areas, I usually show you the ADX to determine trend or non-trend. Well, I also use this Arun indicator, and sometimes you'll see this in the videos, and then long periods of time you won't see it. I'm really looking at these red or green lines. When the red lines are at the top, that means sellers are in control. When the green line's at the top, that means the buyers are in control. Right now, both of them are declining, and then down below, there's an oscillator that measures the difference between the two. It's been flatlining, but it's below zero, so that's negative, and that means that sellers are still winning out as we've been chopping sideways. And this chart will go sideways for long periods of time when the market goes sideways, because it's not registering anything new, and that's why I haven't been showing it lately. Then looking at breadth, we have the advanced decline line, both based on price, and we had a really strong up day on Friday, and volume also had a strong day. And then this is a line, and how we measure this is when it's above this moving average and going higher, that means that price is improving. Well, down below we have volume, which is showing some improvement, but it's also below this declining red line. So that speaks a little bit more for, yes, it's getting better, but it's still negative. We have the advanced decline ratio. We compare a 19-day exponential moving average and a 39-day exponential moving average, and they're right about in the middle with a little bit positive because of Friday's upward movement. But this just gives us an idea of what is the trend of the advanced decline ratio doing. In a good, healthy environment, we'll want to see both of these lines going up. In a bearish environment, when we're going down, we'll see both of these lines go down. Well, with the choppy sideways action that we've been seeing, they've been chopping around the midpoint currently. Accumulation distribution on an up day, this will turn up. On a down day, it will turn down. Lately, we're just a little bit above this moving average, so that's a little more positive. Then some short-term things. I have a short-term rainbow, which looks kind of cool, but we can actually get some information from this. Not necessarily right now. That's why I haven't been showing it. But this is a 10, 20, 30, 40, and 50 period simple moving average. And by how these moving averages are moving in a good solid uptrend, you'll see this look more like a ribbon. Well, as we've been bouncing up and down in 2022, this is just looking more like a roller coaster right now, a real mess. I also have an intermediate term chart and a long-term chart that I'll show you later. There's another indicator called the force index, and we're not really hitting any extreme right now. Where I really pay attention to this is when we hit either the upper Keltner band. It's like Bollinger Bands, if you heard of them. Well, Keltner bands are just a different way of calculating the bands, but we're looking kind of positive here, and I try to highlight where we're at, but we're not giving any kind of an extreme reading, which is why I didn't include it in the video. The McClellan oscillator, a very important indicator that we use. When it's above zero and advancing, that is positive. When it's below zero and declining, that's negative. And then we can get to extreme positive or negative territories on this indicator. Then we have some moving average studies. I look at the 20, 50, and 200. If they're going up and not above these blue lines here, that means they're not extreme, but they're showing that they are currently advancing. But I didn't include them because I usually only bring these up when we're giving extreme readings. Intermediate term indicators. This is a new one. I've never showed this in any other video. This is something that I kind of created myself, and it's very simple. It's just a moving average of the open, high, low, and the close. And you'll notice earlier in 2022, when we were going up, we were well above all four of these moving averages. Well, when we started coming down and then we bounce back up, sometimes when we're going down, this will provide resistance. Well, back in October, when we were going up and then we saw a decline, sometimes these moving averages will provide support. So I wanted to start including them. And then way over on the right-hand side, we hit the upper moving average here, and that might be providing some resistance. And we're also seeing that in some other indicators as well. Then we look at the 50-period moving average, both the simple and the exponential moving average. And right now, the red one, that's the simple moving average. And this is what a lot of investors use. We came right up to that on Friday and then came down slightly from that. The debate goes back and forth. Do we use exponential? Do we use simple? And I explain the difference between them in my class. And I just say, okay, let's use them both, because some investors use one and prefer that, where other investors prefer a different moving average. Then I also have another chart of the 100-day moving averages, both the simple and exponential, where this is also providing some overhead resistance after the nice up day that we saw on Friday. Here's the intermediate term chart showing the 50, 60, 70, 80, 90, and 100 moving averages. And not really right now, but we can get some information from this, but we're just kind of chopping. We go a little bit above it, then below it, and the lines are kind of going crazy all over the place. So it's really not as helpful. It just shows a lot of indecisiveness in the market. Another one is the Sean trend meter, which is more neutral right now. And if the market keeps going up, this will continue to go up until we get into this positive area, but then we could go up too far with this indicator, but we haven't done that for quite some time. But it would just suggest that we're extreme positive, but we're far from that right now. Here's another price momentum oscillator. These are some studies attached to that indicator where we look at the PMOs that are rising. And I show this quite a bit, but usually only when we're showing something extreme. Also with the number of buy signals in the S&P 500 and those percent of PMOs that are above zero. And we're showing improvement here, but not necessarily anything extreme. The Chaikin oscillator, when it's above this zero line, that's positive. When it's below, that's negative. So this is also showing some improvement. The Chaikin money flow, also when we're above or below zero, that's either positive or negative, but it's really been moving sideways. Another thing that we really like to keep an eye on is volume, and volume's been below average. And now some of that can be attributed to Christmas and New Year's and the holiday mode that the market's been in. Well, we did see a real increase in volume on Friday, and we like to see that because it validates a price move, either up or down. When something goes up on lower volume, that's a warning flag. Or if something goes down on lower volume, that's also a warning flag. So now that everybody has come back, hopefully they're done with their vacations, we hope to see volume really start to pick up. If you have a lot of indecisiveness, volume will still remain fairly low. Then we have the vortex indicator. We have a red line. When that's on top, that's negative. When the green line's on top, that's positive. Right now, we are negative, even though the red line is coming down and the green line is going up, but they haven't crossed yet. I've changed up the oscillator chart a little bit. I've tried to categorize them. The top two are short term. We have the slope and the trend strength index, that's TSI. These tend to move a little bit faster. Then we have the MACD, the PMO, and the PPO. These are intermediate term oscillators, and they calculate things a little bit differently. People will have their favorite oscillator, and I decided a long time ago, I'm just going to look at all of the ones I can find because they're calculated a little bit different, and sometimes they'll tell us things that the other oscillators are not saying. And then at the very bottom, we have the TRIX and the KST, which is a little hard to read here. These are longer term oscillators. Then another thing is the ease of movement. What's the path of least resistance? And I measure this going back 1 day, but the one that I look at the most is I go back 14 days where this is improving, but it's still below this dashed line. So it's negative and not giving us any kind of an extreme reading. Ultimate oscillator also vacillates between 70 and 20. And when it's above the midpoint, that's positive. When it's below, that's negative. And it can also help us with overbought and oversold indications. Money flow index, same thing. It's below 50 right now, so that's negative, but it is showing improvement. And it can also give us extreme positive or negative readings. The CCI 14, I showed that in the video for Monday's session. That's a little shorter term where we have the CCI based on 20 periods. It's the commodity channel index. This one is just about at the midpoint, where the 14 period is also already giving us an extreme positive reading. Here we have a TTM squeeze. This is a trading system that we look at this histogram when the lines are a little bit darker, which kind of goes counterintuitive. Excuse me, when the lines are lighter, which is counterintuitive, that means that we're gaining strength. When we finally break above this midpoint and these dots are green, that means that we're in a good solid uptrend. When we're coming down and these are also green, or if not turning red, that means that things are turning more negative. Then we have balance of power. When we're below this dashed line, the balance of power is negative. When we go above it, it is positive. And then we have the CMB composite index. And this is a trading system as well. When the first signal is generated when you cross the first line, and then it's confirmed when you cross the second line. So that would be an actual buy signal that is being generated by the system. The inverse of that is also true. When we cross below a line, that's a warning sign. And then when we cross below the second line, that's a sell signal. Connor's RSI, which is a variation of the relative strength index. We generally use this to look at is it above or below 50 to get positive or negative bias. But then sometimes this will give us extreme positive or negative readings. And then I have been showing this quite a bit lately, but it's not really showing anything now. This is a double exponential moving average and a triple exponential moving average. That's the red and the blue lines here, just giving us an idea of trend. And then on this same chart, I have an anchored moving average going back to the COVID low and whether we're above or below that. And you can see that we've been dancing right around that level recently. Some different charts. One is a Heikin Ashi. This is just a different way to draw price charts, where when you see black candles, that's negative. When you see open candles, that's positive. And you can see we have a real mess going along right here, but it's turning a little bit more positive with Friday's advance. The Kigi chart, when it's black and going up, that's positive. When it's red and going down, that's negative. Well, it had been negative and it was red, but after Friday's move, it's just starting to turn over into black. So that's slightly positive. Renko also doesn't really take time into account. It just takes price movement into account. When we have open boxes like this, that's positive. When we have red ones, that is negative. Three line break, also open candles positive, black candles negative. Point and figure also does not take time into account. It draws upward movement as a series of X's and downward movement as O's. And then there are signals that are generated. And back on December 15th, there was a double bottom breakdown. And when the signal was generated, I'll show that in the video, but we haven't seen any more X's or O's drawn lately. So that's why I didn't include it. Different trading systems. This is the go, no go system. When it's purple and dark purple and going down, that's negative. When it's dark blue and going up, that is considered positive. So this is more of a mechanical system that you can use. Some long-term charts. Here's the long-term rainbow with the 50, 75, 100, 125, 150. Oh, you can read the numbers on here. But this, in a good solid uptrend, we'll see these moving averages really flow underneath price. When we're in a downtrend, we'll see them flowing down with price underneath the rainbow. Also, a longer term moving average study based on the 50, 150, and 200 day. But when I really pay attention to this is when we cross the midpoint and when we get to an extreme positive or negative reading. Special K, another long-term oscillator, which is still suggesting that we're in a downtrend and getting kind of extreme negative. This just shows how far are we away from the 200-day simple moving average. I'm going to have to fix the drawing or the words on here, but this just shows that we're getting further away from the 200-day moving average. We actually crossed back above it in early December, but then quickly went back below the average. Some broad market things, we use the Elder Impulse system. I have that right now that I'm showing in the recent video for the S&P 500. Well, this is the diamonds, which are the ETF based on the Dow Jones, and it is currently positive. And then the Qs, which is the NASDAQ 100, that was neutral for most of the week and then switched over to positive on Friday. Here's the NASDAQ 100 showing that overall we are in a downtrend. We have the 50-period moving average below the 200. And if we ever get back to the point where this crosses back above, that's known as a golden cross. Way back over here, when the blue line crossed below the red line, that's called a death cross. And then this is the VIX of the NASDAQ 100, and they call it the Vixen. I just love that name. And this is kind of a crazy chart. It looks like I have icicles hanging down here. But this just shows us the volatility of the NASDAQ 100 with the bar chart, and then we have the line chart down below. And even as the NASDAQ 100 has been going down, we haven't really seen the Vixen go up all that much either. Kind of the same as what we're seeing with the S&P 500. Here's the NASDAQ itself, which had a recent, I should say not recent, but it crossed over negative in early 2022 and has been in a downtrend ever since. Some other broad markets that we look at, we keep an eye on the dollar, which had just been going to the moon for most of 2022, but is now seeing weakness. And if we continue to stay below these moving averages, we will see a death cross pretty soon. And then we look at the correlation between the dollar and the S&P 500. A lot of times when I say, oh, the dollar was down and that gave support to stocks, or the dollar was up and that was resistance for stocks, I get that from this chart. The blue line to the red line, that's considered neutral. But when we break above the 0.25, that means that both the dollar and the S&P are tending to go in the same direction. The closer they get to 1, the closer they're going in the same direction. Well, the inverse of that is true. When we drop below this red line, that means that they're having a tendency to go in opposite directions of each other. And I have lots of charts that are like that. Here's S&P to oil, where they're neutral to slightly going in opposite directions. And then looking at bonds, we have a total bond ETF. This takes into account short, intermediate, and long-term bonds. And this is the price of bonds. So as price is going up, that means interest rates are going down. When this is going down, that means interest rates are going up, and this continues to be in a downtrend, even though it has been showing some improvement recently. This is a world bond index showing that we've been in a pretty significant downtrend, but we're bouncing up out of that. And if we can continue to go higher, we might see a golden cross. Then we also keep a close eye on the yield curve. And these are all the different yield curves that I plot, but this is kind of hard to read. So then I bring up each individual chart. This is the 10-year yield to the 5-year yield, and showing when it drops below this line, that means it's inverted, that the 5-year is getting a higher rate than the 10-year. And we also have the 30-year to the 5-year. You can actually get more of a return by getting in a 5-year bond right now than you can in a 30-year bond. And then we have the 10 to the 2, 10-year to the 2-year. This is what a lot of people pay attention to. And when this went inverted, this is when a lot of people went crazy over that. But then we have another one, which is 10-year to the 3-month curve. This was the last yield curve to go inverted and then stay inverted. And this is just suggesting economic weakness going forward. And then I also bring this up a lot. This is a daily chart of the yields all the way from the 3-month, the 2-year, 5-year, 10-year, and 30-year, and gives you an idea. And when they're all jockeying back and forth and crossing over each other, that just shows that they are inverted. Then some other correlations, stocks and bonds. In a good, healthy environment, stocks will go up and bonds will go up, meaning that interest rates are going down. They're having a slight tendency to do that. But this also means if stocks are down, bonds are probably down as well. We also like to keep an eye on the S&P to the 2-year yield. It's just a little bit out of the neutral territory now, where they usually will go in opposite directions of each other. And then this is the S&P to the 10-year yield, also having more of a tendency to go in opposite directions. And then the tech sector, which is your real growth, that's where you get the Amazon, the Google, all the tech companies. Well, it's getting back more to a neutral stance when you compare it to how interest rates have been rising. And for a lot of 2022, we saw them going in opposite directions. As interest rates were going up, tech is going down because they have to borrow a lot of money to do research and development. And they generally don't pay dividends, but they will have a tendency to grow. That's why they're growth stocks. And so they have to borrow money to do that. Then our possible positive scenarios. Sometimes I'm talking about these all the time. Well, not right now, because a lot of them are at midpoints where you have the 19-day exponential moving average of the advanced decline line. When this gets extreme negative and then bounces back up, and this red arrow is where we're at right now, a lot of times that marks a low in the S&P 500. Well, we marked that low, but then we went up and then we've been coming back down. So both based on price and volume, this isn't really a legitimate signal right now, which is why I haven't been showing it. Another one are the percent of stocks in the S&P that are above their 200-day simple moving average. When we hit an extreme negative, that often marks a low in the S&P. Well, we didn't quite get down to this extreme reading, but we came down and tested this twice and we've been bouncing back up, but we're not seeing a real corresponding move in price within the S&P. Then on a shorter term basis, we have the S&P 500 stocks that are above their 50-period moving average. When it goes extreme negative, that often marks a low in the S&P. And when it gets extreme positive, that can mark a top in the S&P. And then to give it more of an intermarket look, we also look at the mid caps and then the small caps. When all of these are generating signals at the same time, that tends to mean that we're hitting critical mass. But we hit that critical mass only to go up a little bit and then come right back down. Another thing that we look at is the 10-day average of the S&P 500 highs minus the lows. When we get to an extreme negative reading, that often marks a low in the S&P and can sometimes be a launching point. Well, we've registered a number of signals here in 2022, but it didn't really lead to any significant movement. It did for a while. And that's why when they get extreme, I'll talk about them. But when they're dangling around where they're at right now, I don't bring them up in the video. And then we look at the American Stock Exchange, the NASDAQ, and the NYSE together, and we take a 5-period moving average of the highs and the lows. Again, we're looking for extreme negative readings and sometimes even extreme positive readings. Well, we had some extreme negative readings, but it hasn't led to a lot of follow through with price action. We also keep an eye on the small caps as well. In a good, healthy environment, they tend to be more risky stocks, and people will want to get into those. I'm keeping an eye on this right now because we could be getting ready to see a golden cross here if the blue 50-period moving average goes above the 200. And then we look at the small caps to the S&P 500 ratio. In a good, healthy environment, we'll see this chart going up. Well, it's been chopping sideways for most of 2022, even though it is showing a little improvement. And then we look at the small cap, the S&P 500 ratio. That's the red line right here. And a lot of times this will start to go up and that will give some support to the S&P 500, but it isn't doing that right now. Another thing is going back and forth between value and growth, where in late 2021, we saw what is considered to be here a positive divergence, where we were making a lower low with the S&P and a higher low with the QQQ ratio to the S&P 500. And we saw that with discretionary and with large cap growth against large cap value. Well, after that, we saw a lot of weakness in the market. And this should have been where we're seeing more strength. This just meant that folks were getting more in, the smart money was getting more into growth areas and getting out of value. And that held up for a while, but you can see specifically since last fall, all of these have really been underperforming. Then I have a little longer term chart to show here where we look at large cap growth value, mid cap and small cap growth to value, where it looked like they were starting to break out, but now they have been underperforming as of late. And then we also look at the S&P to utilities ratio. When we bottom with this ratio and start to go up, a lot of times that marks a bottom in the S&P 500. Well, we hit a bottom there and started to go up, but then stalled out and are now coming back down. This can also be used to mark a top in the market as well. When this gets to a spike up and then starts to come down, that may mean that we've topped in the S&P, but it's really not giving us any kind of a signal right now. Staples, the things that you have to have no matter what's happening in the economy, just had a recent golden cross here, and these have been outperforming other growth areas, or specifically the discretionary sector, the things that you would like to have that make life more interesting. So I like to keep an eye on that sector. So those are just the charts that I did not include in any of the other videos. I don't think there was any repeats. Let me know what you think of this. If you still think looking at these once a week or so is still helpful to you, it's not a lot of extra work to do this video, but I'm more than that. I want to know if you find this useful and relevant. So let me know in the comments or send me an email at spxinvesting@gmail.com, and I'll take whatever you say into consideration.